Welcome to today's class. We stopped yesterday with the direct and iterative methods for solving a system of linear equations. You've seen that you can solve for a system of linear equations by using Gaussian elimination or by using the LU decomposition of a matrix. The fundamental difference is that the speed with which you can solve the system is fundamentally different. Gaussian elimination takes up to 100 times more time than simply doing an LU decomposition of the matrix, of the coefficient matrix. And in some cases, you want to resort to an iterative method. For example, a Gauss-Jacobi, Gauss-Seidel, also the so-called SOR method. These are iterative algorithms, methods, which work in the following way. They start with the start solution, and then they work themselves through a set of iterations, a set of solutions, and in each iteration the algorithm tries to improve on the last found solution, so that after 3, 5, maybe 50 iterations it has finally found a solution that is sufficiently exact. Why would one want to use an iterative method? Yesterday I told you that these iterative methods are especially useful when it comes to sparse matrices. So these are matrices that have a lot of zeros as entries, and Gaussian elimination and also LU decomposition. In these cases you will have a lot of computations that simply consist of 0 times 0 plus 0 times 0 and so on. And the computer will perform all these computations and it will use up time, whereas the iterative methods, they will simply see that they can move into the direction of the exact solution in a much quicker way by moving away from the zeros. Okay. So Gauss-Jacobi, Gauss-Seidel, SOR, these are some iterative methods, and let's look at Gauss-Jacobi. We again have a system of linear equations, A times x equals b, and we assume that this is given by A equals d plus c, with d being a diagonal matrix. That is not, this is a given in any case. You can simply take out the diagonal from the matrix, and you can split up the coefficient matrix A into the diagonal matrix D, and the rest C. So, for example, if we had a matrix 1, 2, 3, 3, 4, 5, 5, 6, 7, this of course is just 1, 4, 7, 0, 0, 0, 0, 0, 0, plus and so on, 0, 0, 0, and you have 2, 3, 5, 3, 5, 6. No big deal. Okay. Then the system of linear equations is of course equivalent to d times x equals minus c times x plus b. You simply, if you know that a is d plus c, you split it up and you bring minus c times x to the right side. Okay, quite simple. But then the iteration condition of the Gauss-Jacobi method is simply given by n plus 1 solution x equals minus d inverted times c times the previous solution in the nth iteration plus d inverted times b. So you simply multiply the inverse of the matrix D coming from the left to d times x, and then of course here it vanishes, and you still have to multiply the inverse of d to the right hand side of the equation coming from the left. So this is the result, and this iteration sequence, it converges, converges provided that the spectral radius of the matrix minus D inverted times C is smaller than 1. You can prove that for this to work and for this iteration to converge, the spectral radius of the matrix minus inverse of D times C is smaller than 1. And in case this is given, the iteration will converge. Again, remember what is the spectral radius? The spectral radius, if you go back a couple of slides to the matrix norms, you might remember that the spectral radius is in fact the maximal absolute eigenvalue of the matrix. So you need to know the eigenvalues, and you have to take the maximal absolute eigenvalue, and then for this matrix you know whether the Gauss-Jacobi method converges or not. Let's look at this in MATLAB. We define a new function Jacobi, as input values. We take a matrix A, a vector B, a starting vector x0, a real number eps, and an integer max iter. These are, of course, the epsilon with which the precision with which we want to calculate the solution x, and the maximum number of iterations. So we're telling the function that, for example, after 1,000 iterations, it should stop. Okay. By the way, when we define a function in MATLAB at first does not know what a, b, and x0 are. You could also enter, for example, a real value or a complex number. It will only decide later on in the program, in the function, what this should be and what computations it can do on a, b, and x0. Then, this here, does anyone remember what this means? Function vector xi equals name of the function and input values a, b, and so on. Yeah?
These are the outputs?
Yeah, these actually we don't have one output, but we have an array of two objects as outputs, and the two objects are x and I. At this point, we do not know whether x and I will be numbers, vectors, matrices, etc. Later on, we'll see that x probably is a solution vector, and I is supposed to be the number of iterations that has been used and that was needed for convergence. Second line, dA is simply diag of A. This is a function in MATLAB that extracts the diagonal elements of the matrix A, and it constructs a diagonal matrix. So dA is more or less capital D here. This is, in our program, it's dA. C is A minus the diagonal matrix. Oh no, I have to be precise. Actually, dA is a vector of the diagonal matrix of these entries. So C is A minus a diagonal matrix with dA as the entries. You only need a vector, and MATLAB will insert these entries of the vector as the diagonal entries of this matrix. And then, of course, C is just A minus the diagonal matrix. Dinf is what? It's a diagonal matrix with 1 divided by the elements of the vector dA. And remember, if we write something like this, this will mean that we have a vector of 1 entry A1, 1 A2, and so on, 1 AN. So this operation here is done element-wise. And it's not a scalar product. It's not a matrix product. It's done element-wise. So if you put a small dot in front of the operator in MATLAB, all the operations will be done element-wise. Is that clear, the difference? Yeah? Okay. Not really? If you have two vectors, x and y, yeah, you probably know that in this case, for example, 1, 2, 3, you have to transpose one vector and it will look like this. And what is the result? Yeah? You have the scalar product, the scalar Produkt, and you know that you take two vectors and the result will be a real number. Yeah? But if you, for example, you can write this in MATLAB like this. But if you write x dot star y, it will do the following. The result will be 1 times 1, 2 times 2, 3 times 3, and the result will be a vector. Because the operation, the multiplication is done element-wise, yeah? And it's not a vector product. Okay. Why is this the inverse of D? Simple result, if you have a diagonal matrix, the inverse of a diagonal matrix is simply the entries on the diagonal inverted with respect to multiplication. And the inverse of a number a is 1 over a if you invert it with respect to multiplication. Yeah? So this is the inverse, this is D inverted. And this is quite simple because D is a diagonal matrix. B equals minus the inverse of D times C. B1 is the inverse of D times B. And then we have to initialize the vector x. All x equals x0. This is the starting vector. Then we have a loop starting from 1 to the maximum number of iterations. X is b times the old vector plus b1. Actually, why did I do this? This is a frequent error when programming and when writing a function like this. If you have to include a loop, a for loop or an if clause, usually a for loop, you could also write x equals minus inverse of d times c plus the previous x plus d inverse times b, just like we've written here. But if you take a closer look at this one is a constant in each and every iteration, and this one as well. So you can do two things. You can program it in a rather stupid way and just do it line by line and include this exact formula in the iteration within the for loop. But that would mean that in each and every iteration you will have this product and this product. And you will, in every iteration, compute the very same number, or the very same number, over and over again. But you only need to do it once, so you can include it before the loop. So you just put it here. B equals minus d inverted times c. B1 is inverse of d times b. And then you only do this once, and you can access this from the memory within the loop. So x equals b times old x plus b1. This is the iteration. And then at some point we have to stop. If the norm of x minus the old x is smaller than epsilon times the norm of the old x, break. And then we go out. Old x equals x. What does it mean? Here, this is our, this is personal taste. You can also come up with any other clause with which to end the iteration. I simply said that if the difference between the previous solution x, old x, and the new solution x, if this difference is smaller than the norm of the previous solution times a very tiny variable epsilon, then the iteration should stop. Yeah? This is frequently done if you can see that actually the solution does not change much going from one iteration to the next. You can stop. If the change in the solution is so small, you should stop. And what is this here? What does this mean in line 11? Old x equals x. We have to reinitialize the previous solution with the new best solution, or the new solution. So we have x0. x0 is given here. Old x equals x0. So old x is x0. We go through the iteration, we find x, and then we say, okay, old x is now written over with x1. We start again in the for loop, we find a new x, and then this is x2, and so on. So we have to reinitialize the old x with the newest solution, and then we end. So let's do this here. We have two matrices, A1 and A2. You can see this is a 4 times 4 matrix, 3, 1, 1, 0, 1, 5, minus 1, 2, 1, 0, 3, 1, and so on, and a vector 1, 4, minus 2, and 1. Exact 1 and exact 2 are A1/B and A2/B. These are the solutions for the system of linear equations when using Gaussian elimination. Remember that this slash operator is the Gaussian elimination in MATLAB. And although we'll probably have some rounding errors, let us assume for a moment that MATLAB can give us the exact solution, even if it takes a couple of seconds longer. So exact 1 and exact 2, these are the solutions we are looking for. Then x1, I1 and x2, I2, we take our function to these two matrices, Jacobi, A1, B, zeros, and 10,000 iterations. And we say that epsilon is supposed to be 10 to the minus 8. So 8 decimal places precision. You can see here that we start with the starting vector 0, 0, 0, 0. We have no information with what we should initialize the starting vector, so just take the 0 vector. Okay. You will probably have an idea what will happen next. x1 is pretty close after 41 iterations. x2 is a number that is probably close to the wealth of Scrooge McDuck. It's 10 to the 27th, and it has used all of the 10,000 iterations. And this is, of course, by construction, because here, let's take D1 and D2 as the diagonal matrices of A1 and A2. Let's construct C1 and D, and you can see that if we take this matrix, again, this is minus D inverted times C, EIG, EIG, is a standard function in MATLAB that gives you the eigenvalues of a matrix. And then we take the absolute eigenvalues and the maximum absolute eigenvalues. So this here is just the spectral radius of the matrix, minus D inverted times C. And you can see that for the first one, A1, the spectral radius is below 1, and the convergence condition is fulfilled. However, in this case of the second matrix, A2, actually the convergence condition is not fulfilled. Slightly, it's above 1, but even 1.0059 is enough to cause this iteration procedure to diverge. And we've used 10,000 iterations, and the solution we've come up with is obviously wrong. So here you can see that for this matrix, it doesn't work. And it's quite instructive to see that actually this matrix does not look very horrible. It's actually quite close to the first one, but with the spectral radius being above 1, the Gauss-Jacobi method will not converge. Okay, any questions? These are just, in fact, 3 methods to solve for a system of linear equations. At many points one will use this, and as I've said before, especially actually in production management, in logistics, you will have optimization problems in which you often have systems of linear equations, and these have huge matrices with many zero entries. So in many of these cases you will use an iterative method. Okay, if you have no questions, then let's turn to the capital asset pricing model and later on portfolio optimization. Now in this subsection we want to talk a little bit more about portfolio theory and the results that come from portfolio theory when it comes to asset pricing. At the end, we'll talk a little bit about portfolio optimization and how it can be done in MATLAB and the practical problems one encounters when doing portfolio optimization in a computer. Because one will easily see that, yes, you can build an optimal portfolio, but in terms of practical relevance, it might not be very practical. For example, if the optimization tool tells you, yeah, you have 100,000 euros, simply go to the bank, take up 5 million euros, invest it in stock A, short sell stock B with 150%, you will be violating numerous constraints, and not just your budget constraint, but usually also your short selling constraint and so on. And we will see that if you insert more and more constraints that are necessary in practice, you will be able to optimize it in time, but you will be far from the efficient frontier of all possible portfolio sets. And we will learn the basics of the capital asset pricing model. Who of you has already heard about the CAPM, the capital asset pricing model? Just, yeah. Okay, a couple of people, okay. So we'll talk about this and later on also on portfolio optimization. Okay. And yeah. The first thing one needs to remember now is we've seen already the Markowitz portfolio theory, in which we saw that portfolios form an efficient frontier, an efficient edge. If there is a portfolio lying here, we know that this portfolio is dominated by the one that is lying strictly above. And we have an efficient frontier of the set of all possible portfolios. The question now is, if you have 2 investors, which portfolios will the investor choose? And each investor. If you have 2 investors, well, actually we cannot say anything about that. If we have 2 investors, they can choose any portfolio on the efficient frontier, and their particular choice, their individual choice, is subject to their individual risk preferences. If we have a risk-loving investor, he will probably choose this one. If we have a risk-averse investor, he will probably choose the minimum variance portfolio. So it all depends on the individual risk preferences of investors, and we can include this in our optimization scheme by using preference functions or utility functions. As you might remember, especially in microeconomics, in the end it's not about money, it's about utility. Investors and households get utility from consumption, from investment, and they can consume their returns, of course, so from consumption, labor, free time, etc. And in this case, we can come up, for example, with a preference function V that depends on the expected return and the volatility of the return. And a very simple example of such a utility function or preference function is the following. V is defined as the expected return minus A times the volatility, with A larger than 0. A obviously is a risk aversion parameter. Why? If we say A is 1, this would mean that every unit of volatility is subtracted from the expected return, and the higher volatility is, the lower the preference function's value or the utility will be. If A is suddenly 100, volatility will be weighted in a much stronger way than with A equal to 1. So A is the risk aversion parameter that governs the inclusion of volatility here in the utility function. Now, the individual optimal investment program is then given by a very simple optimization problem. We have to maximize the preference function with respect to mu and sigma, the mean expected return, and volatility being elements of the possibility space. So we need to look for portfolios that are allowed and can be constructed from the set of available individual securities. Okay. Now, small example. Let's look at this preference function. Again, it's quite simple. We are in the two security scenario. We have mu2 plus mu1 minus mu2 times x minus a, and now this here is of course the definition or the result for the volatility of a, let me just check, I think, yeah, this should be, we changed it a little bit here. For the variance of a linear combination in two random variables. And the first derivative is simply given by the second line. We have to find the roots of the first derivative, and solving this with regard to x gives you x equals 2a divided by variance 1 plus variance 2 minus 2 times the covariance. Bless you. It's quite simple. For a to infinity, we get the minimum variance portfolio. Okay. Now, remember that, first of all, the portfolio needs to be, we need to be able to construct the portfolio from the set of individual securities, but we also need to restrict our optimization to the set of portfolios on the efficient frontier. Therefore, the optimization should also run not just over M, but M star, which is the set of efficient portfolios. In many cases, one could go one step further and optimize not just with respect to the expected return, but with respect to the portfolio's excess return compared to a benchmark. This is what every one of us would do probably. We have a common general understanding of what the risk-free rate currently is. We would probably assume it's 0. And in normal cases, one would assume that the risk-free rate is, let's say, 2%. And we would then argue that we need to maximize the excess return, or the excess return with respect to a benchmark portfolio or a benchmark index, so that we want to make more money than, for example, we would get from an investment in the DAX or in the S&P 500. This is meant with the portfolio optimization with respect to a benchmark. In this case, we would still try to find the optimal portfolio weights x1 to xn in such a way that the portfolio achieves the highest possible expected mean return minus the benchmark return with a given volatility. And as benchmark, we could use the S&P 500, DAX, etc. Now, then the optimization becomes maximize the excess return, with RB being the return on the benchmark, with it should have equal volatility or equal variance, and again the portfolio weight should all add to 1. And here we would of course know that in this case, the portfolio weights of the benchmark do not need to be optimized because they are given. You simply know the weights, for example, of all the individual stocks in the S&P 500 or in the DAX index. Okay. Now, I think some of you yesterday already said that when it comes to portfolio optimization in practice, one might also want to include a shortfall restriction. And this is one given here. One could not just look at volatility, one could also say that we want to maximize our utility function, which could be mean return minus 8 times volatility, subject to not just a budget constraint, a short selling restriction, and maybe further restriction on the portfolio weights, but also with an additional shortfall and safety first restriction. This means that first of all we would have to look at the shortfall probability, which is P, the probability that the return falls below a certain quantile, and then it's actually the same as a value at risk constraint. We would demand that the value at risk of the portfolio does not fall below a certain threshold, which is equivalent to demanding that the shortfall probability should be higher than a certain amount. Okay, so we have a shortfall constraint, and we could go on and on with all types of constraints that could be included in this optimization scheme. Certain asset classes, regulatory constraints, shortfall restriction, then short selling constriction, and so on and so on. And here you can see, for example, with the expected minimum return of 6%, you can see that actually the in this mu sigma graph here, you can see that if you change the risk aversion and you try to control shortfall risk, that of course with higher risk aversion, this line slightly goes up, and it's also tilted. Okay. With different types of expected returns, you can see that this is moved in parallel upwards, and then you have just yet another constraint in your optimization. Next, let us deal with the case of several periods. We haven't talked about portfolio optimization in time. This has just been done in one period. Next, we could, for example, also demand that the probability of R1 plus R2 plus and so on plus RT divided by T larger than M should be larger or equal than 1 minus epsilon. What does this mean? It means that the average return over T periods should be higher than the minimum return M with probability 1 minus epsilon. So we are demanding not that on every day the return is at least, say, 5%, but we want the portfolio to give us a certain minimum mean return over a window of T periods, of T days, T months, etc. Now, if we assume normally distributed returns, we have mu plus z quantile times sigma divided by square root of t for a quantile, and this is quite simple if we know this. If you have taken a basic introduction to statistics, you will probably remember this type of writing a quantile. So you can see that actually this here is just demanding for normally distributed returns that mu, the return, the expected return, is larger than m plus the quantile of the normal distribution. So this is quite simple, and in fact, if we increase t, you can see that actually the restriction is more easily fulfilled with larger time periods 1 to t, which is not surprising, because if we say, well, over the next say 5 years, the mean return should be higher than say 1%, this is more easily fulfilled than requiring, okay, over the next 5 days, I want the mean return to be higher than say 1%. Okay. So this is one way of including a restriction, a shortfall restriction that is that covers the time aspect of portfolio optimization. Okay. Furthermore, one could also require the return to be higher than a certain minimum in every period. So every day we are expecting at least 1%. This is of course a tougher restriction to fulfill. And if we now assume, unrealistically, admittedly, but still, if we assume an IID distribution of the returns over time and a constant minimum return MT equals M, so M is constant, we have the probability that R1, the return in the first period, is larger than M1, and the return on the second, in the second period, is larger than M2, and so on. We want to calculate this probability. Then we see that this is always M. We set M1 and M2 up to MT to be constant and to be M. Then this is, if it is IID, you know, this is the product of the marginal probabilities. So the product from 1 to t of the probability, no, the product of the probabilities that the tth return is larger than M, and this actually is just the probability that it is larger on any day to the tth. And for the constraint on the probability, we then have we take the tth square root, the tth root, then we require the probability of the return to be larger than M, to be larger than the tth root of 1 minus epsilon. And this is then the restriction and the constraint we include in our optimization. Okay. You can see that this term is a quantity that increases with t, and this means that this is a tightening and a tougher restriction on the minimum expected return, and thus on the optimization. And this is obviously in line with our intuition, because if we require the next day's return to be higher than 5%, it's still easy for this to be fulfilled. But if we require the next day and in 2 days and on every day the return to be at least 5%, this is tougher to fulfill. Okay. Now, under shortfall restrictions, we could then optimize the expected return with respect to portfolio weights should be between 1 and 0. They should add up to 1. And then the probability of R being less or equal than M should be lower or equal than epsilon. So we invert it, and we don't demand that the expected return is higher than with a given probability, but we demand that it's a shortfall restriction that the return should not fall below M with a probability that is smaller than epsilon. Okay. Now, if we assume a certain statistical distribution for the returns, we can convert the first constraint into a quasi-deterministic linear inequation. In this case, the optimization is actually quite simple. What happens is we just have a possibility space M, and we take the shortfall constraint, and this is quite simple. It cuts through the set of all possible portfolios, and we can see that suddenly only these portfolios are feasible. We can also include additional constraints. This will only lead to more constraints, and then we see, okay, that in the end we only have to look for solutions in this area, for example. And this is how it actually works. Okay. Well, same here. You can see that you have your efficient edge, and if you include all the shortfall restrictions, you realize that actually these are the only portfolios that fulfill all these shortfall restrictions. And then you have to look for your optimal solution on this part of the efficient frontier. Okay. This portfolio optimization can also be displayed like this as a process of portfolio optimization. You have as input data your expected returns, your risk measurements, usually the volatilities, the covariances or correlations. You need a preference function, you need a target function that is sometimes supplied by your investor or by your customer. You have a benchmark and you put it all into an optimizer, and at the end what you get is, of course, the optimal portfolio weights and the expected return and the volatility of your optimal portfolio. So this is more or less portfolio selection and portfolio optimization. Now, Markowitz portfolio theory is synonymously used with this mu sigma paradigm and this scheme of maximizing expected return and trying to keep volatility at a certain level. The problem in practice is that you can do this, and I'll show you later on in MATLAB how this works out. The problem is that this optimization is more or less purely mathematical in nature, and it does not take into account some of the restrictions and constraints that you have in practice. For example, if you do not include any constraints, Markowitz portfolio optimization, and this theory is infamous for producing portfolio weights that are quite extreme. So you will not end up with, say, 10 and 90%, but it might be that you actually end up in minus 350 and plus 450%. And the optimization scheme would tell you, simply go to your bank and take up 1 billion as a loan. So this is not very practical. So the portfolio weights are often very extreme. Next, the portfolio weights are often quite sensitive to changes in the model parameters. So if, for example, for one security, the volatility changes just a little bit, it might be that you have 10 and 90% as portfolio weights, and suddenly you have 87 and 13%. In practice, this would mean that you would have to move large parts of capital out and in of certain asset classes and certain securities. And you would be buying and selling securities all the time, and in the end you would lose money and your brokers would earn a lot of fees. So transaction costs will cause this to, not to work. Okay, so you need to take into account transaction costs. You need to take into account certain restrictions on the portfolio weights, short selling bans, that you need a budget constraint, and so on. And this is why Markowitz portfolio optimization, this type of portfolio optimization, is usually not done in practice with respect to individual securities, but do you have an idea where this scheme is often applied? You do not try to find the portfolio weights for securities, but you try to find the weights for asset classes. So instead of using stock A and stock B, you do the same, but with stocks, bonds, maybe derivatives, stocks in a certain country, and you try to find the optimal weights with which you should invest into certain asset classes, because asset classes are not as volatile, and the market parameters, for example, of bonds and stocks, the market parameters on average for these asset classes are not as volatile as the market parameters for individual securities. So the weights you get in your optimization, they will not change too much. And for this, you use this optimization. Okay. So next, let's turn to the capital asset pricing model. Because of these mentioned problems of Markowitz optimization and portfolio optimization, you use it for asset allocation. And at the security level, you often resort to so-called factor models. And the capital asset pricing model is the most prominent example of such a factor model. There are also other factor models, probably even more famous nowadays is the Farmer-French model. And what is the idea behind these factor models? In empirical testing, you try to find factors that are able to explain the cross-section of stock returns or security prices. You try to find the factors that explain the cross-section of stock returns, and do you know which factors can explain or which are said to be able to explain the cross-section of stock returns? Yeah?
The market return.
Market return. So the market portfolio, this is the first one. Actually, this is the one we'll see here in the capital asset pricing model. So this is an example of a one-factor model, and which additional factors?
Market capitalization.
Yeah.
Size of the portfolio, stocks in the portfolio.
Yeah.
Also the value versus growth.
Yeah. Market cap and valuation. SMB and HML. High minus low and small minus big. And the idea is that you're not buying the market, that's just like with the market portfolio, but at some point Farmer and French saw that there seems to be a fundamental difference between the returns on small and big companies and on high minus low valued companies. And what they did is they took, for example, let's assume we have the S&P 500. You simply sort all the companies in the S&P 500 by size, market capitalization, and then you buy the smallest 10 and you short the largest 10. You take the profits from selling the largest 10 stocks short, and you invest this money in the stocks that are the smallest. In the end, you will get what we call an arbitrage portfolio. This portfolio will have a value of 0 because you are short in the largest ones and long in the smallest ones. So you've taken in 10 euros or $10 and you've already invested it. So the portfolio has a value of 0. But it goes extremely into the direction of size. No? Actually, growth opportunities. Smaller companies are said to have larger growth opportunities, and stock returns seem to be higher for smaller companies than for large, mature companies. And then this portfolio will, if actually size is a factor, and if it drives the cross-section of stock return, this portfolio will generate excess returns. And it usually does. So this is the second factor. And the Farmer-French model by Eugene Farmer and Kenneth French is also called the Farmer-French three-factor model. And it's size and valuation. It has been extended numerous times. I would say the next best thing is the Farmer-French Carhart four-factor model. Do you know what the fourth factor is? What could also drive the cross-section of stock return? Momentum. What is momentum?
It means that you buy stocks that has higher return than the average portfolio.
Last year?
Last year or in the last 3 to 12 months.
Yeah.
And short sell these that
yeah.
have had lower returns.
Yeah. You simply look at, for example, the last 3 months or the last year, buy the winners, short sell the losers. Very simple. And this is called momentum because you assume that the winners will continue to win and you will see the losers going down for a further time. Okay, so this is momentum, and this is the area of asset pricing. I have lost track of all the different factors that have now been identified. You can use numerous other factors, but these are the most important ones, Farmer-French and Farmer-French Carhart. The basis for this is the capital asset pricing model. So let's start with a very simple market model or factor model. We assume Ri and Rmi to be the returns of the ith individual security and the market index, and then we assume that the individual return Ri is given by a alpha factor plus a beta factor times the market return. And this very much looks like a regression equation, right? We try to explain the return on the ith individual stock by using the market return as an explanatory variable. So this is a factor model. Now, in the case of the CAPM, of the CAPM, the capital asset pricing model, the market index portfolio is given by the market portfolio itself, and it is not approximated by an index. For this simple one-factor model, we assume the usual assumptions we also do in ordinary least squares regression. The expected value of the disturbances of the error terms is 0. The variances of the error terms is sigma I squared, and the error terms are uncorrelated with the returns Ri. Under these simple assumptions, it follows that the covariance between the return on the ith individual stock and the market return is Bi times the variance of the market return, or Bi, the estimate for beta, is covariance divided by variance. And this is how we usually estimate the beta factor, the stock's beta. Covariance with the market divided by the variance of the market. So this is the beta factor of the investment I. The beta factor measures the sensitivity of the ith individual securities return to the return on the market portfolio. So if the market goes up or down, the beta factor governs by how much the return on the individual stock will also go up or down. We also can see that the expected return is given by the alpha factor plus the beta factor times the expected return on the market. And you can see what? The alpha factor is what? What is this? Yeah? What is it? What is the alpha?
The excess return.
Yeah, the expected excess return over the market. So, for example, if the market return has an expected return of 5% and the alpha of a stock is 3, you know that it will give you an expected return of 8%, and it has a 3% excess return over the 5% market return. So the alpha tells you by how much the expected return on this individual stock is higher than for the market. Okay. Now, it also holds that sigma, the volatility of the market return, is given by the sum of Ci times the correlation times the volatility, with Ci representing the index weights with which the index is built. Now, therefore, the volatilities of the individual investments enter the volatility of the market index just in part, and we break this down, we can see that this here, the volatility of the stock or the security more generally, is given by correlation times volatility plus 1 minus correlation times the volatility. And this first term is called the systematic risk, and the second term is the unsystematic risk. Why? Here you can see that actually if you have a correlation of 1, you can see that this part vanishes. Let me just check that first. Yeah, the second sentence is me. Yeah. So by choosing the correct value of and the correct combination of securities and a security that has handy correlation, you can see that you can actually reduce unsystematic risk and diversify unsystematic risk to 0, and you are left with systematic risk. The systematic risk is simply the systematic changes of the securities returns with the market return. Okay. So we can see that only systematic risk contributes to the volatility of the market index, and the unsystematic risk can be eliminated or diversified. And with the beta factor, we can see that actually here, systematic risk, or the beta factor, is given by the systematic risk of the investment divided by the market risk. And based on these results, we're now going to derive the capital asset pricing model. We no longer assume a linear structure between RI and RM. We don't need this, but usually in regression analyses, we take just a linear structure. You can estimate the parameters of the market model using empirical data and regression analysis. Then the alpha as well as the beta factor, these are the coefficients estimated from your regression analysis. As input data, you need the observed returns of the market index portfolio. And in practice, one can see that the assumptions of the model as well as the linear structure are usually not fulfilled. If you were only to try out this one factor model, you will probably get a bad fit. This is why people started to look at 3-factor models, at different factor models that do not rely on a linear structure, and then you are able to explain the stock returns and expected stock returns in a much better way. Here, this is what you can do. You have your individual stocks. You can see that you have the return of the market portfolio and the return of the individual stocks, and you try to put a line through this, and you try to empirically estimate the beta factor. Okay. Now, this is the situation in which we only have n risky securities that can be formed into an index, into a market portfolio. Now let's extend this model by including a risk-free security with return R0. Please note, this is actually a simplification. Usually you will not have one risk-free rate, but you will have several risk-free rates for different maturities. You will have a risk-free interest rate for maturity 1 year, 5 year, 30 years. So you will have an interest rate curve and a yield curve that is not constant. But in this model scenario, we assume that we only have one risk-free return. Any amounts of capital can be invested or borrowed at the risk-free interest rate, and all investors only take the index's expectation value and variance into account in their decisions. A, between 0 and infinity, is the part of the available amount of money which is invested in a portfolio, and 1 minus A is the remaining part that is invested in the risk-free investment and risk-free security. Then the overall return is of course given by R equals A times the return on the portfolio plus 1 minus A times R0. It's actually quite simple. For the whole portfolio, based on the risky portfolio, P, and the risk-free investment, we have, again, mu equals A times the portfolio return, mean return, plus 1 minus A times the risk-free rate is equal to risk-free rate plus A times mean return on the portfolio minus risk-free rate. And the volatility is actually quite simple. Why? Because the risk-free investment has a volatility of 0. And you get sigma squared equals A squared times the variance of the portfolio. If we say that A, and this is quite simple, if we simply write it in this way here, this means that we can also write the mean return on the portfolio consisting of the risky stock portfolio and the risk-free investment is equal to mu equals risk-free rate plus portfolio mean return minus risk-free rate divided by portfolio volatility times sigma. And What is this? If we have a constant portfolio, and if we only vary the share A of P in the whole portfolio, we will get a straight line through the risk-free rate with slope mean portfolio return minus risk-free rate divided by portfolio volatility. Yeah? Again, here, this is the volatility, of course, of the portfolio of stocks plus risk-free investment. So it's correct that there is no sub-index P here. And this is the so-called Sharpe ratio. The slope of this line is what we call the Sharpe ratio. It's the excess mean return on the stock portfolio over the risk-free rate divided by the portfolio's volatility. And this is the Sharpe ratio. The Sharpe ratio can be used in risk-adjusted performance measurement. Why? Because it can be interpreted as mean excess return compared to the risk-free rate divided by risk. So it's actually the market price of risk. We can also use a generalized Sharpe ratio, which is also called the information ratio. This is the excess mean return divided by the volatility of the difference between the return RI and the benchmark. Okay. Now, we have risk-free and risky investments. Let's start with the risk-free investment. Actually, it might be that we have a portfolio P here, and we have the risk-free investment here. And you can see that if we invest 100% in the risk-free investment, we will be here. If we invest 100% of our capital in the risky portfolio of stocks, for example, we will be in point P. If we take, say, 50-50, we'll probably be here. If we, well, how can we get to this point here?
Borrowing?
Yeah, we can borrow at the risk-free rate and say we invest 150% in the portfolio. So this is the line between R0 and P. If we have different portfolios, P1, P2, and P3, we get different lines running from the risk-free rate up to the risky portfolios. And what happens now? Remember that we have different portfolios. We can build different portfolios. And let's assume we also have a portfolio here. And this is the efficient frontier. And you realize that this portfolio is inefficient. This portfolio is inefficient. And actually, you can look at this portfolio and you can see that in the scenario of n individual stocks of a portfolio P1 that combines these individual portfolios, individual stocks, and risk-free investment, you get something that looks like this. And this is the result of the so-called Tobin separation, of the two funds theorem. In case you only have n risky assets and no risk-free investment, no risk-free asset, the decision on your portfolio is investor-specific. If you have, as an investor, a different utility function, different risk preference, you choose a different portfolio. But as soon as you enter a risk-free asset, all the investors do the following. Suddenly, just this portfolio is efficient. Because why? For example, if you were to take the minimum variance portfolio, you can see that why should I use the minimum variance portfolio with 100%? I can simply buy portfolio P with just 80% and invest the 20% remaining into the risk-free asset. So the minimum variance portfolio is dominated by a combination of risk-free asset and P1. Why should I not use this portfolio? Again, borrow money and invest in P. You get the same return with you get the same risk with a higher return. So this here, this tangent portfolio, this is what we call it, suddenly dominates all the other risky portfolios. And this is the Tobin separation. Suddenly, all investors will choose the same portfolio, P1. They will nevertheless still choose the best individual combination of risk-free asset and risky portfolio, but the portfolio stays the same for all investors. And why is it called the Tobin separation or two funds theorem? Well, suddenly you invest in two funds and you don't do portfolio selection. And it's called Tobin separation because you can separate the portfolio and investment decision from the risk preferences. The risk preferences only decide on how much money you invest in the risky and the risk-free asset. This is very central. Why? This is a very fundamental theoretical background for a common empirical observation. Why do we need this as a theoretical background? For what? Because the basic result is don't care about your portfolio, simply buy P. Everyone buys the same portfolio. And this is what? Yeah? A benchmark. We will later on see this is a market portfolio or an index. Usually the market portfolio proxied by an index, but what is this? This is the basis for passive portfolio management. There are two types of portfolio managers, active and passive managers. What do active portfolio managers do?
Security selection.
Yeah, what we call cherry picking. They try to find the individual stocks that currently underperform, and they try to find the best securities in the huge, vast amount of securities around. Very costly. You need a lot of good portfolio managers that try to find the best stocks for your portfolio, and you have to rearrange the portfolio every time. In contrast, what do passive portfolio managers do? Passive portfolio managers do what? They buy an index. They try to mimic, they try to proxy for, say, the S&P 500, and their argument is just, you cannot beat the market. So let's just buy the market. They will save on transaction costs. They will save on general management costs because passive portfolio managers do not need so many people and so much personnel. And this is the fundamental basis for this, the theoretical basis for passive portfolio management. The two funds theorem or the Tobin separation tells you that it is not sensible and it's not able to beat the market simply by the market portfolio. And then decide on how much money you should put in the risk-free asset and how much money in the portfolio. Yeah. This is what I've just shown you on the other slide. You look for the tangent portfolio on the efficient frontier. Okay. And this is the Tobin separation. And you can separate the portfolio composition from investors' risk attitude or risk preferences. Okay. And this risky part is structurally identical for all investors. And last but not least, the Sharpe ratio. So the expected excess return divided by risk is maximal for the tangent portfolio. So you can simply try to find the portfolio that maximizes the Sharpe ratio. Okay. This is a very basic result. And now let's turn to the capital asset pricing model in its pure form. We want to derive equilibrium prices for securities. This is the basic onset. The following assumptions hold. The market includes n risky assets and one risk-free security. We have the same assumptions on the securities. They can be divided, there are short sales, etc. There are M investors with a budget VI each in the market. Whole market volume is V equals the sum overall VIs. All investors have identical expectations towards risk-free rate, mean returns, variances, covariances, etc. And at the start of the model, the market is in equilibrium. If you do not know what equilibrium is, this is in German, that's Gleichgewicht und Gleichgewichtspreise. So supply and demand are in equilibrium. Okay. Now every investor buys an efficient portfolio PI consisting of the tangential portfolio T and the risk-free security. The demand portfolio is given by sum of over all investors, lambda I times VI times XT. This is the demand side. The supply side works like this. It consists of all available securities, so the market portfolio is defined so that every individual security is fixed towards the relative share PI divided by P of the complete market value. And the investment vector is now XMI, XMN with this as the portfolio weights. Now, as the supply portfolio, the number of available securities is strictly fixed. In equilibrium, we should have sum overall investors, lambda I times VI times XT has to equal the price P of the market portfolio times XM. The consequence of this is that actually XT and XM must be equal, and P equals the sum of all the individual investors' wealth. And in equilibrium, T equals M, and this means the tangent portfolio has to be the market portfolio. This is the basic result and the fundamental result of the capital asset pricing model, that you start with an obscure tangent portfolio which you don't know anything about, but it turns out that the tangent portfolio is always the market portfolio. And this again is another fundamental brickstone for passive portfolio management, because it's not just passive portfolio managers buy the tangent portfolio, but passive portfolio managers buy the market, and you cannot beat the market. This is the basis for passive portfolio management. Now we derive some central consequences from this. The set of all optimal portfolios is given by expected return equals risk-free asset return plus Sharpe ratio times sigma. So you can calculate and estimate the the expected returns on the securities, and the resulting straight line. You can see that this is actually a line in the sigma mu graph. This is called the capital market line. The market portfolio again has the maximal Sharpe ratio. Only portfolios that duplicate the market portfolio in their risky part are optimal, and this is passive portfolio management, or also what we call indexing. Moreover, for the expected return of any portfolio, we have the expected return is given by risk-free return plus beta factor times the excess return of the market. And this is, if you draw it in a plot, this is what we call the security market line. The difference between the two is that in the first case we have a mu sigma graph. In the second we have a mu beta graph. So security market line shows you how the expected return depends on the beta. So this is the capital market line, German Kapitalmarktlinie, sigma and expected return, and the security line is beta and expected return, and of course, here you can see the expected return and volatility of the market portfolio. And here in this case, trivially, the beta factor of the market portfolio has to be 1, of course. Now, the sensitivity of the market portfolio with itself is 1. Okay. Now, the beta factor measures, as we know, the sensitivity of the individual return towards changes in the market return. So if we rearrange it in a little bit, we get this result. Expected return minus R0 equals beta factor times the market return of the excess return on the market. So excess return of the portfolio, or rather of the individual value, corresponds to the excess return on the market weighted by the beta factor in equilibrium. And you should always remember what beta and alpha factors tell you. The alpha tells you something about the excess return, and the beta factor tells you something how the excess return on the market portfolio has to be weighted in order to get the excess return on the individual stock. And this, again, here below, you can also see this is sometimes called the market price of risk. If you divide the excess return by the volatility, and you can then interpret this as follows: expected return equals risk-free rate plus market price of risk times systematic risk. Also a very famous interpretation of the capital asset pricing model. Okay. Now, at the start, I said that the capital asset pricing model is a pricing model. It is meant to derive prices. But actually, in asset pricing, one can easily see that it's equivalent to find the returns and expected returns. And in many cases, investors do not really care about prices, they care about returns. So most of these asset pricing models really are about excess returns and expected returns. But you can also reverse engineer the prices. And the price here is simply given by the expected value of the market divided by 1 plus the risk-free rate plus beta times the excess return on the market. So the price of the portfolio corresponds to the expected return V discounted at the risk-free rate corrected by a risk premium. So you have a risk-adjusted interest rate in this expression, and you use it as a discount for discounting the value, the expected value of the portfolio. Okay, any questions concerning the capital asset pricing model? Again, if you go to the literature and if you look up research papers on asset pricing, you will probably find numerous new factors that are being tried out, or the econometric methods that are used for testing hypotheses regarding new factors, and it has become a huge literature. And I also have to admit that at some point it has become a little bit ridiculous. There are even papers around that have titles like asset pricing with garbage. I think they construct an asset pricing factor using consumption and garbage data, and yeah, this is what is done in asset pricing. But market return, small minus big, SML, high minus low, HML, no, SM, small minus big, SMB, and HML, high minus low. These are the famous 3 factors of Farmer and French, and Farmer, French, Carhart, momentum, and this is asset pricing. By the way, this is of course all in equilibrium, and Eugene Farmer received the Nobel Prize in economics a couple of years ago for this type of research into asset pricing in, I would say, near perfect capital markets. So if everything goes well, if you have a working capital market, asset pricing models will tell you what prices should look like and what the return should look like. And as you might remember, Eugene Farmer from the University of Chicago received the Nobel Prize together with Robert Schiller from Yale, who also looked at prices, housing prices and stock prices, but from a behavioral finance point of view. Because these models do not work if investors are dumb, do not have all information, if prices are not in equilibrium for some reasons, if markets have frictions, then of course these results will not hold. No? So as soon as you insert behavioral finance aspects, this will not produce equilibrium prices, and you will not be able to reproduce these empirically. Okay, do you have any questions? So I don't think it makes sense to start with convex optimization in just 2-3 minutes. If you do not have any questions, thank you for your attention and see you next week. Thank you.